G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, we're going to be discussing Dropbox's latest quarterly earnings and going over my latest thoughts on the company as well as my valuation. As you can see here, Dropbox is my second largest holding in my portfolio. It makes up almost 8.5% of my portfolio. So it is very important to me that I stay up to date with this company. So guys, before we get into this video, make sure you like this video and subscribe to my channel. And if you really enjoy and align with my analysis, please consider copying my portfolio here on eToro. No mucking around. So total revenue, it increased 7.9% to 572.7 million. And if we have a look at the constant currency basis year-over-year growth, it would have been 8.8%. In terms of ARR, which is annual recurring revenue, it grew 7.7% year over year, and on a constant currency basis, 8.3% year over year. You can see that in terms of paying users, over the last year, Dropbox has increased their paying users by about 1.2 million, which is an average of 300,000 per quarter. I think in this particular quarter, compared to last quarter, which was Q1, they've added about 280 million new paying users. And if we have a look at their average revenue per user, this is known as ARPU, it increased only modestly compared to the same period last year. And historically, this has grown at a much faster rate. However, there is a very good and valid reason for this. So Dropbox have introduced more Teams plans where these Teams plans have 6 users per account. And as a result, these plans have actually become quite popular. And if we're taking average revenue per user, obviously if there's 6 people in the one plan, that's going to pull this average revenue per user number down. However, this isn't a bad thing for the business, as the management team made it very clear in their investor conference call that these Teams accounts that have 6 people in them, they're very sticky and the churn rate is very low. So overall, it is while the ARPU might not be growing as fast, as a result, the platform itself is much stickier. So if we move on to GAAP gross margin, it also increased compared to last year, and non-GAAP gross margin increased compared to last year, which is quite spectacular to see. They've already reached their long-term targets, their 2024 targets for their GAAP gross margin and for their non-GAAP gross margin. So they're really excelling here, which is fantastic. In terms of their GAAP operating margin, it has slightly decreased compared to last year, but if we look at it in non-GAAP terms, it was flat. This was mainly because of they've hired a few more people, as their headcount has risen slightly compared to last year. So that's an extra expense there, which is going to bring down the margin. However, some of their initiatives that they've been doing to improve the retention and churn rate of the business, it is well worth it. So GAAP net income, it was down compared to last year, but the management team attributed that to the significant increase in income tax expense due to the impact of new R&D tax legislation. So Dropbox used to be a loss-making business, and now it's turned into a profit-making business, and pretty much they've used up all their tax losses, so now they've got a bigger tax bill, which is just normal for any business that's profitable. Free cash flow, it's decreased from last year. However, this is not a big issue. We're going to take into account these same reasons why net income dropped. And if we look at the EPS, the earnings per share, in terms of GAAP and non-GAAP basis, these losses aren't these decreases in EPS aren't quite as severe as net income, as the company has been aggressively buying back stock. And then, of course, the company has a lot of flexibility on their balance sheet, $1.446 billion. So this gives them flexibility to potentially do M&A or continue aggressively buying back shares. So if we jump over now to Ticker, we can see the transcript of the earnings call, and I've picked out a few things that I think are quite important. So Drew says in his opening remarks, consistent with last quarter, we once again saw our overall churn rate fall year over year. Now, why is this? Well, he puts it down to two reasons. The first one being that they've improved the UI experience. It's now faster and it's more user-friendly in their mobile app. They've increased the overall number of photos previewed on the mobile experience by over 10% since the start of the year. And they've also nearly doubled the percentage of active users on the app who upload content compared to just a quarter ago. So on top of these UI, or as he says, UX improvements, we're seeing increased adoption in multiple Dropbox features among our paid users. We're discovering that customers that leverage multiple capabilities retain at higher rates than those who do not. So essentially, they're finding out that people who have multiple Dropbox features, people who pay for multiple Dropbox editions, these people have they retain at higher rates. They have lower churn rates. Hence, they're putting a lot of focus into trying to get people to have multiple Dropbox features. It makes sense, and that's why we're seeing ARPU grow slower. But we want this business to be sticky. That's what's going to keep the users there. That's what's going to drive that competitive advantage. If we keep going down, I want to talk about guidance. So Timothy Regan, he's the CFO. He talks about guidance in this presentation here. If we just go down, he says for the third quarter, expect revenue to be in the range of $584 million to $587 million. They're pricing in currency headwinds of $13 million in the third quarter. They expect Q3's year-over-year revenue growth to be roughly consistent with that of Q2, so roughly 7 to 8%. They expect non-GAAP operating margin to be approximately 29%, and they expect fully diluted shares outstanding to be in the range of 360 million to 365 million. And they also gave us some updates on the full year. So for full year, this is probably most important, much more important than the quarterly earnings or the quarterly guidance. They expect gross margin to be approximately 81.5%, which is actually up from their previous forecast of 81% due to the ongoing efficiencies, which we've been talking about. We are also raising our operating margin to guidance of approximately 30%, which is up from the 29 to 29.5% prior guidance. And this operating margin guidance is inclusive of approximately 1 point FX headwind, which was previously estimated to be 0.5 points. They are maintaining the free cash flow guidance range of $760 million to $790 million, and this includes a bunch of one-off items such as a $17 million cash outflow due to the installments of the acquisition-related deal consideration holdbacks. I believe this is related to HelloSign. Additionally, the free cash flow guidance is inclusive of an estimated $25 million headwind and resulting from the impact of R&D tax legislation newly effective in 2022. They expect CapEx in the range of 25 to 35 mil. And fully diluted shares outstanding for 2022 to be in the range of 364 million to 369 million, down from their previous guidance range. So very positive things coming here from the Dropbox management team on this conference call. They're executing just as I expected. This business is very consistent. It's safe. The revenues are reoccurring. The product is sticky. It produces a lot of free cash flow. Margins are high. Management team's conservative. There's a lot of things to like about this company. While the growth rates aren't spectacular and don't blow you out the water, you've also got to look at the valuation and look at what we're paying for the business versus what it's actually giving us. So let's actually go have a look now at the valuation. So if we have a look here, I've got a very, very simple, pretty much back of the envelope valuation. So the company is adamant that they're going to hit $1 billion in free cash flow by the end of 2024. The company in the past has been very conservative with their estimations. They always beat their numbers, and I don't expect this time would be any different. So I'm going to take them for their word, put in the $1 billion in free cash flow. It's not even that crazy, honestly. 2024 shares outstanding. I've put in 350 million shares. I think this could be slightly lowballing, but I'm going to be conservative here. And in terms of a free cash flow multiple, at the moment it's trading at like a free cash flow multiple of about 10. I think that's silly. It should be trading somewhere around 15, honestly, for all the reasons why I discussed before. It's a recurring revenue business. It's consistent. It's very profitable. Yeah, retention rates are high. Yeah, it's got a good management team. They're buying back a bunch of shares. There's no reason for this business to trade under a 15 times free cash flow multiple. And if we take that all into account, that gives us a 2024 price target of $42.86. And if we take it from the current share price of $23.55, this gives us a CAGR of 27% per year over the next 2.5 years, all the way out to 2024 or the end of 2024. So guys, this wraps up the video. I hope you liked this update here. And again, make sure you like this video and subscribe to my channel. And if you're interested, make sure you jump over and check out my portfolio on eToro and copy it if you're that way inclined. So thanks for watching, and I'll see you in the next one.